Hey everyone, Rose Brown, the accountant therapist here, and in this video I will be covering estimated tax payments. Now I know it's a touchy subject for a lot of people, but we must have this conversation. I mean, who wants to give the IRS more money that they should be getting? Alright, so as I cover estimated tax payments, I will be talking about the what, who, why, when, where, how, all of the things, so that you can have a better understanding of what is required of you if this is applicable to you. Now, the first thing that I want us to talk about as we kick things off is the fact that the US tax system, it's a pay-as-you-go system, which is to say, hey, every time you get paid or receive money, you are expected to make payments to the government. Okay, so when you think about an employee, as they're working throughout the year, their employer is taking money out and giving it to the government. They're not waiting 6 months and a year. No, as it's happening, the government is receiving the payments. Okay, now in that respect, if you are not an employee and you're receiving income that did not have withholding take place on it, you are expected to pay the government estimated tax payments. Now, this is done on a quarterly basis. It's not done when you file your tax return. It's done beforehand. So when you think about estimated tax payments, think about prepaying your taxes based on your income activities so that you can avoid penalties and interest. Okay, now the folks that are subjected or generally subjected to estimated tax payments are individuals that are freelancers, they're independent contractors, they're self-employed, or maybe they are receiving passive income from rental activities, capital gains, interest, dividends, or maybe they just have a side hustle going on with Uber, Lyft, DoorDash, all of those sorts of things. Once you sit up under those umbrellas, you're generally going to be required to make estimated tax payments. Now, if you're not necessarily in that boat, but you found yourself owing $1,000 or more on your last tax return, you will be required to make estimated tax payments. In fact, the government is expecting to receive some sort of payments because they know that you owed $1,000 or more in the prior year. Or if you expect that you will owe $1,000 or more, you do want to go ahead and make those estimated tax payments. Now, one may ask, well, what are these things due? Now, these are quarterly payments. They're not even quarters. So I'm going to give you the dates, and this is one of those things where you want to make sure you jot it down on your calendar so that you don't miss it. All right. So the first quarter is due on April 15th. Second quarter is due on June 15th. Third quarter is due on September 15th. And fourth quarter is due on January 15th for the prior year. Now, missing these dates, you will expect to see interest and penalty accompanying that payment that you should have made, right? Now, in making your estimated tax payments, even though a date may fall on a weekend, you're not pressed to make it on that day. You can make it the next business day. In fact, that is when it will be due, the next business day. So if it's a weekend or a holiday, it pushes to the next business day. Okay. Now, in terms of how to calculate this estimated tax payment, there are several different ways, but you have to understand that some of them will cost a little bit more just to kind of get closer to what that amount will be. And some are just as easy as saying, you know what, whatever it was before, that's what I'm going to pay now. All right. So let's talk about it. You want to make sure that you account for whatever your total income was, right? Any expense or deduction that you have, and that net activity is what you'll be paying taxes on. And generally what that means is you're going to use your tax bracket and or depending on the type of income, the FICA tax rate, which is 15.3%. Okay. Now, if we look at an example, let's say you made $100,000 and your deductions were $50,000. Now you have $50,000 left to pay taxes on. Okay. Now, outside of that, there is something called the safe harbor rule, and safe harbors are actually really fun. And this is very important because this can help you save time to a certain extent, money, if you just want to take the easier route. And this is not to say it's bad, but it's just not the most strategic way. But it is an option that the IRS gives so that you don't find yourself having to pay penalties for not making all the payments that you should have. So what the safe harbor rule says is you can pay either 90% of your current year tax liability, or you can make 100% of your prior year, or if you had $150,000 of income, that would be 110% of that prior year. Now, as I'm saying, remember, you're prepaying, so you're paying the money ahead of time. You're not waiting until April 15 comes to make those payments. Okay. Now, one may ask, well, how do I make these payments? Well, fortunately, you have a few options. If you have your IRS account, you can log in there and make the payment so that it can just be on account in your account. You can go to the IRS's website and use Direct Pay to make those payments. You can also use EFTPS if that is an option that you want to utilize. And then lastly, which is not the recommended option, is to mail in a check. The IRS is actually doing away with those things. So try to do everything electronically so that you don't find yourself with a missing check, and you can screenshot the proof that you've made this payment, those sorts of things, okay? Now, one of the last things that I do want to touch on is if you fail to make your payments on time, you will see underpayment penalty. You could see interest on that balance that have not been paid. And then of course, a surprise bill from the IRS, which nobody wants, but it is something that is possible. And then lastly, and this is a tip, right? A business owner tip. And actually, any person can utilize this. But generally, as a business owner, what you want to do is whatever your net profit is, the rule of thumb is 70-30. So 70% comes home with you and 30% you set it aside, maybe in a savings account to pay to the government. Now that 30%, that generally covers your federal, state, and local taxes. And that's to also say it could be less than 30% when you're filing your tax return, or it could be greater, but the rule of thumb is 30%. Now, we know that estimated tax payments are not exciting. It's just one of those things where it happens and it's a requirement of everyone who is a part of the US tax system. But if you are self-employed or a freelancer, or you have withholding that did not take place, understanding what is required of you is critical, because paying the government more money means you get to enjoy your money less because you don't have it. But that's really what estimated tax payment is all about. If you did find this content helpful, which I hope you did, go ahead and hit that like button, subscribe, and if you have any questions, drop that in the comment section, or if I don't respond in the comment section, I will make a video about it so that you can have a better understanding. Again, my name is Rose Brown, also known as the Accountant Therapist, and I am the CEO of Brown's Advisory and Accounting Firm. That's all for now, and I'll see you next time.